Hello and welcome to this tutorial on money market instruments. Money market instruments is a fundamental part of the financial markets. These instruments are primarily used by governments, corporations, and financial institutions to handle short-term liquidity requirements. By definition, money market instruments are financial assets with maturities typically of less than 1 year. The main purpose of money market is to facilitate efficient liquidity management, allowing entities to borrow or invest funds for short durations, usually at relatively low risk. Because of their short term nature, money market instruments are particularly useful for managing cash flow gaps and maintaining financial flexibilities. They offer a combination of high liquidity, low risk, and low return, making them an attractive choice for both issuers and investors seeking temporary solutions to financial needs. Let's look into the key characteristics of money market. First, looks into the liquidity. One of the most attractive features of money market instrument is their liquidity. These assets can be quickly converted into cash, making them ideal for managing short-term needs. This liquidity allows issuers to maintain financial flexibility and investors to withdraw their investment without facing significant losses. Risk. Because the issuer of money market instruments, governments, top corporations, and financial institutions are typically creditworthy and trusted entities, the risk of default is minimal. Moreover, their short term maturity period, typically less than a year, reduce exposure to factors that could impact long term debt instruments, such as fluctuating interest rate. Because of these reasons, these are the money market instruments are considered as low risk. Let's look into the return part. The safety and liquidity of these instruments come at the cost of low return. Since the risk of loss is low, the compensation for holding these instruments in form of interest or yield is also low compared to high risk or longer term investments like stocks or bonds. Despite the lower return, these instruments play a vital role in financial markets, helping institutions secure short term funds without taking on unnecessary risk. Now let's look into the types of money market instruments. Each instrument serves a different purpose, but they are all share the common characteristics of short maturity and liquidity. The most common types include treasury bills. These are short-term government securities issued at a discount and repaid at face value at maturity. T-bills are considered one of the safest investments because they are backed by the full faith and credit of the government. They are sold with maturities of 91 days, 182 days, or 364 days and are a key tool for government cash management. The second instrument is commercial paper. So, large corporations issue commercial paper to finance their short term liabilities such as payroll and inventories. CP is an unsecured short term promissory note, meaning it is not backed by collateral, making it slightly riskier than government securities. However, it typically offers higher yields and is issued with maturities ranging from 1 to 270 days. Certificate of deposits (CDs). Banks issue CDs as time deposits with a fixed interest rate and a specified maturity date. They can range from 7 days to a year. CDs are popular among conservative investors looking for a guaranteed return and capital preservation. While the interest rates are usually higher than those for standard saving accounts, early withdrawal from CDs may result in penalties. Now let's look into the another instruments called bankers acceptance. Often used in international trade, a banker's acceptance is a short-term credit investment created by a non-finance firms and the bank guarantees it. The maturity is typically between 30 and 180 days. It is similar to a post-dated check but involves a guarantee by a bank, which reduces the risk to the holder. The last one is repurchase agreement, or in short called repos. Repos are agreements where one party sells securities, often government bonds, to another with a commitment to repurchase them at a higher price on a specific future date. These agreements are primarily used by financial institutions to manage short term funding needs. Repos can range from overnight agreements to those lasting several weeks. Each of these instruments play a crucial role in maintaining the stability of the money market by offering liquidity and short-term funding. Now let's look into them one by one in details. So treasury bill. So by definition, treasury bills are short-term debt securities issued by governments to meet their short-term funding needs. How does it work? T-bills are sold at a discount to their face values, which means that investors purchase them for less than the amount they will receive at maturity. For example, if you buy a T bill for $950, you will receive $1,000 when the bill matures. T bills do not pay interest. Instead, the difference between the purchase price and the face value at maturity represents the investor's earning. Maturity. The maturity period of T-bills are short, typically range from 91 days, 182 days to 364 days. The short maturity help reduce risk as the government financial positions is unlikely to change drastically in such a brief period. Let's look into the risk and safety of T-bills. T-bills are considered virtually risk-free because they are backed by the full faith and credit of the government. Investors rely on government's ability to meet its obligations, making T-bill one of the safest investments. How it is used? So T-bills are widely used by the government to smooth out fluctuations in its cash flow. They also provide a way for governments to finance short-term deficits. For investor, T-bills serve as a safe haven in times of market uncertainty, offering capital preservations with predictable if modest returns. Let's look into the liquidity. So T-bills are extremely liquid because they are short durations and government backing, allowing investors to quickly sell them in the secondary market if needed. Now let's look into the commercial paper. So commercial paper by definition is an unsecured short-term debt instrument issued by large corporations to finance short-term obligations such as inventory or payroll. How does it work? So since CP is unsecured, it relies entirely on the issuing corporation's creditworthiness. Companies with high credit rating can issue CP at lower rates, while the firms with weaker credit pay higher yields to attract investors. The typical maturity period for CP ranges from 1 days to 270 days. Unlike other money market instruments, commercial paper does not have to be registered with regulatory bodies if it's mature within 270 days, making it a quick, flexible way for companies to raise funds. Let's look into the risk and return of CPs. While CP is considered a relatively low risk investment, it is still riskier than government backed securities like T bills due to its reliance on the financial stability of issuing company. Returns on CP are typically higher than those on T bills, reflecting the added risk. Who issues the CPs? Only large financially sound corporations with strong credit ratings typically issue commercial paper. It is not backed by collateral, so the company's reputations play a crucial role in attracting buyers. And who is the buyers of CPs? CP is primarily purchased by institutional investors such as mutual funds, insurance companies, pension funds, and banks. These investors prefer CP due to its higher yield compared to other money market instruments. What are the advantages for issuers? The commercial paper allows companies to obtain short-term financing quickly without the need to go through lending process such as bank loans or bond issues. It is an inexpensive alternative for raising capital as interest rates on CP are generally lower than rates on bank loans. Now let's look into the next instrument, that is certificate of deposits. So by definition, certificate of deposits, or in short it is called CDs, are saving products offered by banks and financial institutions. They represent a fixed term deposit with a specified interest rate and maturity. So how does it work? When an investor purchases a CD, they agree to leave their money on deposit with the bank for a fixed period, that is the fixed term, during which time the bank pays interest on the deposit. At the end of the term, the investor receives their initial deposit back along with the accrued interest. The maturities of the CDs. So CDs can have maturity ranging from as short as 7 days to as long as 1 year or more. Short term CDs, those that mature in less than a year, are considered money market instruments. The interest rate on a CD is generally higher than what is available in standard saving accounts because the investors agrees to lock up their money for a set period. Interest rate on CDs vary based on the length of the term, with longer term CDs typically offering higher interest rates. Now let's look into the risk and liquidity of CDs. CDs are considered low risk investments because they are insured uh, by the government. So FDIC basically insured in US, or other countries similarly have different kind of insurance program, meaning the government guarantees deposits on a up to a certain amount. However, CDs are less liquid than other money market instruments like T-bills. Investor may face penalties for withdrawing their money before the CD matures. CD are used by banks to secure stable, low cost funding for short term lending operations. For investors, CD provide a safe, predictable return, with a trade off being that their money is locked up for the duration of the terms. Now let's look into the banker's acceptance. So by definition, banker's acceptance, or in short it is called BAs, are short term credit instruments created by a company and guaranteed by a bank. They are primarily used in international trade transactions, where the bank guarantees that a buyer will pay the seller at a future date. How does it work? A banker's acceptance functions like a post dated check. A company agrees to pay a supplier at a future date, and a bank guarantees this payment, reducing the risk for the suppliers. The supplier may choose to sell this BA in the secondary market to obtain immediate cash rather than wait for the payment date. BA typically have maturities of 30 to 180 days. The short-term nature of BAs makes them highly liquid and suitable for use in international trade finance. The advantages of international trade: uh, the banker's acceptance reduces the risk for both parties in international trade transactions. The supplier knows that a reputable bank guarantees payment, while the buyer can delay payments, which can be beneficial for managing cash flow. The BA are often traded in secondary market at a discount to their face value. This allows the holder to convert the acceptance into cash before its maturity, enhancing its liquidity. Now let's look into the risk that BA have. Since BAs are backed by both the issuing company and the guaranteeing bank, they carry relatively low risk. The quality of a BA depends heavily on the reputations and creditworthiness of the guaranteeing bank. Who uses BA? BA are mainly used by companies engaged in international trade. For example, a US company might use a BA to purchase goods from a foreign supplier with the guarantee of payment provided by a US bank. Now let's look into the repurchase agreements or repos. So repos are short-term agreements which where one party sells securities, usually government bonds, to another party with the promise to repurchase them at a specified future date and price. How does it work? So in a repo transaction, the seller receives cash in exchange for temporarily selling securities to the buyer. The seller agrees to buy back the securities at a higher price, typically within a few days. Repos are used as a form of short term borrowing, and the difference between the sale price and the repurchase price reflect the interest cost of borrowing. Most repos are very short term, often overnight or for a few days. However, some repos can last for weeks or even months. How does how repo are used? So repos are primarily used by financial institutions such as banks to manage short term liquidity. For example, a bank may use a repo to borrow cash to meet its reserve requirement using its government securities as a collateral. Central banks such as the US Fed Reserve also use repos as part of their monetary policy operations to control the supply of money in the financial system. Collateral and risk. The securities used in repo transactions act as collateral, which significantly reduces the risk for the lender. If the borrower defaults, the lender can sell the securities to recover the loaned amount. The risk associated with repos is low, but it depends on the value and liquidity of the collateral. Typically, government securities are used, which are highly liquid and safe. Repos are one of the most liquid money market instruments, making them essential tool for banks and financial institutions that need to manage their cash flow on a daily basis. Who uses the repos? So banks, money market funds, hedge funds and other institutional investors use repos to manage liquidity. Repos are also provide a way for central banks to implement monetary policy by injecting or draining cash from the financial systems. Now let's look into the importance of money market instruments. Money market instruments are critical for several reasons. Liquidity management. They provide a quick and efficient way for organizations to cover short-term cash flow needs. For monetary policy implementation, central banks use these instruments to regulate liquidity in the financial system and to influence short-term interest rates. Money market instruments also used as a credit worthiness indicator. The ability of a corporations or government to issue these instruments at a favorable rates reflect their credit health and overall financial stability. Safe investment option. For investors looking for low risk short term investments, money market instruments are ideal. They allow investors to preserve capital while earning modest, stable returns over a short period. This combination of safety, liquidity, and low risk makes money market instruments an essential part of a well diversified investment portfolio. The key participants in the money market. The money market involves several key players, each of whom play a vital role in the functioning of the system. Government. The governments are instrumental. Uh, Governments use instruments like treasury bills or T bills in short to finance short-term funding needs and to manage national debt. For by issuing T bills, governments can raise funds to cover temporary budget gaps or meet short-term obligations such as maturing debt. Corporation. Corporation, especially large and established one, frequently issue commercial paper to finance short-term operational need such as payroll or inventory purchase. Commercial paper is a quick and cost-effective method for companies to access short-term funding without going through the more formal loan process with banks. Financial institutions. Banks and other financial institutions are significant participants in the money market, often engaging in repurchase agreement, repos, and certificate of deposits (CDs) to meet their daily liquidity needs. Repos, in particular, are widely used by banks to manage short term cash flow and ensure compliance with liquidity requirements. Retail investors. Individual investors also participate in the money market, usually indirectly through the investment vehicle such as money market funds or certificate of deposit. These instruments offer a secure and low risk way for retail investors to preserve capital and earn small returns while keeping their funds accessible. Central banks. Central banks like the Federal Reserve in the US or the European Central Bank in Europe play a critical role in money markets by using these instruments to control liquidity in the financial system. Through operations like the buying and selling of treasury bills or engaging in repos, central banks can influence short term interest rates and ensure the stability of the financial system. These participants together form a dynamic and interconnected system that ensures the efficient functioning of the money market. Now let's look into the chart of risk and return comparison. In the money market, there is a direct relationship between risk and return. The lower the risk, the lower the return, and vice versa. Instruments like treasury bills are extremely safe and offer the lowest return. Commercial paper offers slightly higher returns because of the higher risk associated with corporate debt compared to government debt. Certificate of deposits and banker acceptance offer moderate returns with slightly higher risk than T bills but are still considered relatively safe. Now let's look into the liquidity versus maturities. The more liquid an instrument is, the easier it is to convert to cash. For example, repurchase agreement and treasury bills are highly liquid and typically have a very short maturities. So you can see that T bills has a 95% liquidity and at the end is the 98% liquidity with repurchase agreements. Commercial paper and banker acceptance, though still liquids, tends to have longer maturities. Same commercial paper at 85% and bankers acceptance at 88% because it is liquid but not as liquid as T bills and repurchase agreement. So it tends to have a bit longer maturities up to several months. The trade off between liquidity and maturity is crucial for investors who need to access to their fund within a short time frame. Now let's look into the market size of these instruments. The market size distributions of money market instruments highlight the dominance of treasury bills, which makes up a significant portion of the market, due to its widespread use by governments. So you can see over here is that treasury bills uh, market share is at 35%. The commercial paper and certificate of deposits also hold substantial shares with 25% and 20% respectively, while bankers' acceptance and repos represent smaller portions but are still critical to the functioning of financial markets because the purpose is a bit different for each of the instruments. Now let's look into the benefits of money market instruments. Money market instruments offer several advantages both for issuers like government, corporations and financial institutions and for investors. Risk mitigation. Since these instruments have short maturities, they limit exposure to long-term risks like interest rate fluctuations on credit or credit events. For investors, this provides a stable and secure way to park funds without exposing themselves to the higher volatility of longer-term investments. Portfolio diversification. Money market instruments can serve as a low risk component within a larger, more diverse investment portfolio. Investors who have exposures to more volatile assets like stocks or bonds can balance their risk by holding a portion of their funds in money market instruments. Income generation. While the returns are lower compared to high risk investments, money market instruments still generate steady, predictable income in the form of interest or discount yield. This income can be particularly valuable for conservative investors who prioritize stability and capital preservation. Capital preservation. Money market instruments are well suited for investors who prioritize the safety of their principal. Since the risk of default or capital loss is minimal, they are ideal for those looking to safeguard their funds, especially during uncertainty or volatile market conditions. One of the most significant benefits of money market instruments is their high liquidity. Investors can quickly and easily convert these instruments into cash, making them a practical choice for managing short-term cash flow needs to maintaining financial flexibility. Overall, money market instruments provide a safe, liquid, and reliable option for both issuers and investors, making them crucial component of the global financial systems. Now, to conclude, money market instruments are a cornerstone of short-term financing and liquidity management in both public and private sectors. They allow government, corporation, and financial institutions to raise funds quickly and efficiently without offering investors a secure and liquid investment options. The various type of money market instruments, treasury bills, commercial paper, certificate of deposits, banker acceptance, and repurchase agreement or repos each serve a unique role, but they all share common features of low risk, short maturity, and high liquidity. By understanding the characteristics and functions of these instruments, participants in the financial system can effectively manage short-term financial needs while minimizing risk. Finally, money market instruments not only facilitate efficient market functioning but also support broader economic goals such as maintaining financial stability, implementing monetary policies, and managing liquidity in the financial system. Whether you are an institutional player managing billions of dollars or an individual investor seeking safety and capital preservation, money market instruments offer valuable tools for achieving short-term financial objectives. Now, for the reference, I have created a blog post on this one. I will provide the link in the descriptions as well. And Once you have went through the blog and these lectures, you can attempt the quiz to check your understanding about the money market instruments. Thank you. See you again.